Tara, and welcome to everybody. Good evening, and it is nice always on Saturday you have given a time to attend this. It means itself that you are interested either in learning or doing the investment in the right thing. So before I start today's session on what are the problems where people are facing in mutual funds or how to avoid these things, so let me just put it a small video which talks about why people do investment and how people do investments. So please let me know if you are able to hear me.
Welcome to the world of mutual funds. Did you know that investing in mutual funds isn't just about picking any fund? There are some smart ways to invest and even smarter ways to withdraw your money. Let's check out 3 powerful strategies you can use to make the most of your investments. Want to invest a fixed amount regularly and benefit from rupee cost averaging? SIP is your go-to. It's ideal for investors looking to achieve long-term financial goals and wealth creation. Want to reduce the risk of market volatility by gradually shifting your investments? STP is just what you need. It lets you transfer a fixed amount from one fund to another, helping you manage risk better. Need a regular cash flow without dipping into your savings? SWP is your solution. You can withdraw a fixed amount regularly, making it ideal for retirees or anyone who wants a steady cash flow without the hassle. So, whether you are looking to invest consistently, switch things up, or enjoy a regular cash flow, these strategies have got you covered. Ready to start your smart investment journey? Call us today.
So I'm assuming you all must be having one of those either SIP or STP or one-time investment, which we call lump sum investment also, or maybe slowly SWP, which is when you want a regular payout or retirement time. So this thing has come up very, very recently. So I thought I will start my thing itself with this, because in our, I can say, advisory groups or the distribution groups and all, and this is, I think so till last week fact, that this is the record cancellation of SIP in, it's actually 82% has gone. And what is making 82 or 83% is the highest record cancellation? It is most of the time, if you see, it's an emotion. So whenever the market is falling, the people stop doing an SIPs. And this SIP cancellation is if you see the data which is given by AMFI, AMFI is actually a regulatory body for the mutual fund, even though they also goes to the SEBI. So SEBI is take care of mutual fund and stocks, but AMFI give all the data on a mutual fund. So this talks about the number of new SIP registered and number of new SIP discontinue or the tenure completed. So which is coming 83, which is the highest as on today after the May 24th. So why people, this is making me always think, why people have to cancel the SIP when they must have started, they must have thought, okay, I wanted to do investing for a long term. It can be for a kid's education or an emotions, what you can say, retirement, giving a vacation or anything. It should be linked. And second thing is, most of the time when I always feel, whenever you have gone through yourself or through advice, and I'm sure they must have told that SIP you should look for a long term. SIP is the best because it is giving a weighted average returns. What is weighted average? When the market is down, we are getting more units. So it's like that. We must have heard so many times people telling, or our parents telling, oh, gold is down, so let us buy more gold. Correct? So same concept works here also when the market is low. And if you buy more, so why people are canceling? Why people are removing the money when they actually should be investing? And that is the one point I wanted to bring it. Actually, it is an emotion. It's not the money. It's that, okay, I may lose more. So most of the time, whenever you do investing, please don't link emotions. So this is the another, I wanted to give you the live experience. We got our first car in 2001, and which is on 14th Feb, and our daughter born, and that became such an emotional part of our life that when we wanted to sell that car, my husband said, can we go and buy the new? And I said, no, 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 this is having a so much new car, new house. Sorry, the baby also, we brought it in this car only. When we got a new house also, we got it. So this is having so much of emotion that linked to that car. And he told me very bluntly, he says, if you feel that is going to have so much of emotion, even the kabaddi wala will not take it. So whenever you are looking, I'm not saying emotions are wrong, but at least something when you're looking as an investments, don't add emotions to that. So that is the one. Whenever I go a lot of webinars, because that's my passion. Last week I had, I think so, more than four corporate webinars, and I was just telling the same thing. The difference between you managing and us managing is not that rocket science or something. Of course, people comes to us for two reasons, either a knowledge or the time. But the major difference is when people move from, I can say, we call DIY, do it yourself, versus an advisor, is when their portfolio become big and this is my one mistake may become a bigger mistake because you started adding to the emotions. You say, okay, market is going down, let me remove and stop loss. And sometimes they'll say, no, it may go high and it keeps going down. So that's the one thing. First thing I have noticed people doing is adding investment to the emotions. So please try to do, and this that's the reason I thought I'll start with this, because it's the most new data which I am giving you across is people do. And for me, I always say is the dip is always good for any fund management or any wealth advisory, because that's the time we invest more and you get the more returns. So that's about. So second thing is, I always believe that how you can increase the SIPs, as I say, talking
Welcome to
about.
the world of smart investing. Today, we are unveiling the magic of systematic investment plans. Imagine investing without the stress of market highs and lows. With SIPs, you invest a fixed amount regularly, spreading risk over time. It's like planting seeds that grow into a flourishing financial garden. SIPs offer flexibility, letting you start with as little as a small amount. Another key advantage of systematic investment plan is the power of compounding. Just by investing rupees 5,000 per month from the age of 25 years and increasing SIP amount by 5% every year with top-up SIP can help you accumulate 1.66 crore retirement corpus at the age of 55 years. In summary, SIPs are your financial buddies, making investing stress-free, accessible and rewarding. So, sit back, relax and let the
So this is what it talks about the SIP, where we are talking about long-term power of compounding, thinking long. There are so many things. So we did a one small, I can say, survey kind of it, including us. We said, okay, let us go back and find it out how many people, apart from of course our customer, because they are with us more than 20 years, people are keeping their investment more than 10 to 15 years. And you will surprised to know that the data what we found is not even 10% continues for 10 years plus. When they started with, they always felt it, okay, this I'm keeping for my kids education, this is for retirement, I have to continue for 10-15 years, my corpus will be this. But they are not able to continue for that. It can be fear, it can be greed, it can be some emergency, they feel they need a money and they have taken out, or for what may be the reason. So sometimes we have to start thinking across when we are investing how best we can invest. It is nothing wrong that I wanted for an emergency. Keep that fund, which is you can utilize for an emergency. So that's the second largest thing what I have noticed in people. Most of them that does it is ranking or a past performance. This is so common. They will say, okay, Rachna, you didn't go to the value research or a money control, or this is the rank it is coming, or this many stars they are getting. Of course, a disclaimer, in Right Horizons, we don't look that because we create our own ranking system. But most of the people, they see that. And I'm not saying somebody is right or wrong, because few parameters, we also look those. But most of the time, you just imagine yourself, you are driving a car. I am driving last 30 years. I have never drove the car with a rear mirror. I normally use a rear mirror. Maybe somebody is honking at me at back, or I wanted to take over. So why we should look always to see that good funds should be always from the rear mirror. So past performance and the ranking system is only for the past. And that is the one of the biggest thing I have noticed. Most of the time people look at when their past performance are, and then they actually start buying off. And when they start buying off and suddenly fall, and they said, okay, this is what I my mistake. So this is the one of the rare I can say experience in Indian market, where if you see this Frankel Templeton, all of them were 5 rated fund in all the online portal. Okay. And the next day itself, they were frozen. So they were 26,000 crores was under management at that time, 26th April 2020. So how anybody will know that? They, of course, they have gone through the, most of the customers have got the money after government of India and the court has come to release over the period, but they were not able to do any liquidity on those funds. Of course, we didn't, as a right horizon, we didn't have those funds. The main reason is that we were looking and underlying how a debt fund can give it to you 11 or 12% returns, because it means that they are getting a higher risk, and which is not okay, or liquidity is not okay. So most of the time when people start looking at a risk, they don't realize the liquidity also is one of the biggest risk. I have a customer who has maybe more than 100 crores. And when he comes and talk that, Rachna, I don't have 10 or 15 lakhs. I said, how come it's possible you have hundreds and hundreds of crores and you don't have? He says, no, everything is fixed, Rachna. What I can do with that? So sometimes you don't realize the liquidity ratio or liquidity itself is a very, very big things. So most of the time, just going online portal for a ranking and a star is always not a good thing. So it's okay to take as a first parameter, okay, I'm taking these are the 5 stocks, and then go about and see across. So I was talking recently to the one of the family member of family office customer. A family office for us is like a 50 crore and above. And I asked them that what was the reason you chose us? There are many more people. So their point was very clear that we normally choose on an investment philosophy or how a people manage the risk, and which was the core part for yours. So most of the time, whenever you are looking across any funds, it is good. The best part is you have the, you can say chat GPT, Google, but anything you can available as of today, Copilot or whatever it is, you just try to understand what you are looking at. And because of that little bit, you will be able to do a much better work. So this is the best way. Another way we always says, this we have done it, and which is given by the one of the website by MFI again, that whenever you are ranking in 3 consecutive years, you will find the next consecutive years they are not even top 20 also. So if I see recently, let us say at 14 to 16, if somebody won on first, the next 3 years they were 230th rank. Who is in second is in 30th. So most of the time, if you start looking, chasing the performing fund, you will be going back to the non-performing fund. So go to the concept. You are looking at growth, you are looking at value, you are looking at risk, you are looking the returns. If you don't want all of them, it is okay to sustain the top 5 funds, and that will itself will take care. Look at across normally once in 6 months kind of it. Every day is not going to help. Your anxiety level will go high, but not anything else. So please try to see how you should be a long-term investor. You're not a trader. If you want a daily basis, you become a trader. And you know that most of the time, the data says that 95% of the people who are trading are on loss. And that self hats off to Zero Dhaba itself on Nitin Kamath. I was going through their follow the LinkedIn, and they say that the maximum money you will make is only the broker, because even in buying and selling you are giving to them, rest you are giving a taxation or government of India to the tax, and most of the people are on loss. So what I am going for, so somebody called me around 65 years old and he says, Rachna, I get a kick to just watch. So I said, yeah, that's good for you to take care of your time from 9:30 to 3:34. You just watch and take 5-10 lakhs and play around. When 10 lakhs is over, you are out. You cannot keep doing all of those things. So similarly, the winner always rotate. So it's not necessary what is today's winner is tomorrow's winner also. So if you see the funds and the sectors which keeps changing from 2013 to 24 and here 2010 to 19, whatever I have given, the color itself says that those funds keeps changing. So please don't go always with the past and the ranking. So ranking and all, most of the time, this is the another statistics I was going through recently by Frankel Templeton. It is given the maximum people who lose are the non advisor based or DAY they call. So most of the time, I always says that you required an advisor or anybody you can say mentor or any guide or a teacher. It's like that to make you that you're going on right direction. So most of the time, recently we were in a talking and I go to the yoga and this is this person, Rachna, it's an online, he's having a 1 lakh odd yoga people and all. Of course, he charge very less. It's online. You can do that. It's very good. I said 200% he must be good, but I am not using that. I wanted to go to the physical person because when I am doing a posture, I can't see myself I am doing a right or wrong. I want somebody to tell me that time that is it I am doing right or not. So maybe online you're looking, but that person is having thousands of people online. I have no idea you are doing right or not. Like and now today I'm giving a webinar. I have no idea you are hearing or not or what is right or wrong. So when you have a somebody personal talking about and saying that, okay, this performance is okay. So recently another customer came and he asked me this fund is not doing good. Rachna, I heard my friend told an XYZ. And I said, see, I have will give you the data behind it and these are the value based and which we feel the concept is right. It may not have done last 2 years because momentum has going very fast, but this fund is good. We will continue to do it. So sometimes you need somebody to tell you the reasoning why we feel it is right and then go ahead. I'm not saying that DUI is wrong. I always say it's always good to learn. It's good to learn different portals, learn yourself, but that time you should be accountable yourself. So switching, another thing is a lot of time people switch the fund. So this reminds me, maybe around few months back, somebody called me that thank you note kind of it. That's now that saved quite a lot of money because of you. So I said, what happened? He says, no, you remember that when I came to you, you have asked for that person was a very, very high risk person and I as a person forget as a wealth manager I'm very not a high risk person. So he said that I wanted to put 1 CR for the crypto. Okay. And I said I cannot recommend because as an advisor I'm not allowed to do and I feel the underlying I don't know, I don't know taxation, so I am not going to put crypto part of it. So he says what I should do and I normally say people to nothing wrong to learn something, if comes doesn't come. So I put it across. I told him put 5 and 10 lakhs odd because even if it has become zero, it's not going to impact your lifestyle or your goals. Go ahead. And of course, they was having a so many portal problem. They were going in a things. And recently he says that I lost everything, but he says you saved my 90 lakhs. So sometimes I always says it's I'm not saying that all the advisor is 100% true. We are not God. We will also go wrong. But I can tell you we will be at least 60 to 70% higher than yours because our full-time work is those part of it. So switching funds or thematic, like another thing was China fund. We had queries on US based funds. So whenever you are having a sector or thematic funds, it gives a very good sometime when they are doing, but you should be tracking in and out those because exiting and entering of those funds are very, very important. And if they are not, so if you see in Right Horizon, most of the time we don't go for a sector funds most of the time because these funds are seasonal kind of funds. So you have a lot of time people say, okay, by the time it's doing good, they'll say, okay, I'll get in, and then they start going bad. And that is the one of the reason I have seen most of the customer who have come as a prospect or whenever I have seen speaking about, they have been having a very big loss and because they keep switching. whenever you switch, that's another thought I wanted to put it across. People don't realize there is a taxation impact is also coming. So until unless you find it is a very high, like if we wanted to do profit booking, when we do profit booking, we always says, okay, it should not be short term, it should be taxation. And the difference after taxation should be making an impact, then you do the profit booking part of it. So I'll just have a small video on how people do the.
Ever been stuck in traffic? Thinking you chose the slowest lane? Life's decisions can feel just like that. Especially when it comes to investing. Meet the trend chasers, always chasing the latest top performer like it's the next big thing. But here is the twist. They are falling for something called recency bias. Just like changing lanes in traffic, they switch investments based on recent success. But, surprise, surprise, it often backfires. Top performing investments keep on changing every year. To avoid the investment lane swap, diversify and stick to your lane, as consistency beats chasing trends. Think of it like navigating through traffic routes. Mix and match your investments for a portfolio that can navigate any financial congestion, and then stick to it. So, remember, resist recency bias. Stay in your lane, stay consistent, and win the long game. Mutual fund investment.
So which is so true. I have written this article also in my LinkedIn that whenever we go to the toll and we will be choosing, okay, I'll use the lane 6, and that lane 6, which we think it is going to be a going shorter, so we will just try to say, okay, that other one is which is longer is going much higher, faster, and all this stuff. So this is the one thing, as we always says, as a Murphy law or whatever, we always says the other people are doing faster or going faster. So I always says, you don't bother, because you are unique, your goals are unique, your income, expense, everything, lifestyle is you different. So you always try to do what is good for you, what is right for you, instead of doing what people or friends, they are not against you, they are always for, but other people have a difference. Recently another friend has come to people and they says, Rachna, we both wanted to invest together, and I gave a lot of, I said I will speak with you because I'm not agreeing that you both, it's not that our fund we will not feel happy, but I don't want, because your income and his expense and all your things are different. So maybe it's good to being a two friends coming together for the similar funds, but actually it's not the same requirement for both. So most of the time I have noticed, most people goes what other people says, but you should see your income, your expense, your goals, and your lifestyle. So this is the another thing I remember my mom used to tell us quite a lot, that it's so easy to get a white elephant or an elephant, but maintain an elephant is very difficult. And this is the similar typical thing I can tell you. Getting rich is always maybe easy. A lot of people says, okay, like I'll take a KBC, or I do stay rich, or I have another customer who has exited the business, got around 35 to 40 crores. And he says, okay, I don't want it to work. And suddenly he's telling Rachna, I'm thinking my lifestyle is getting impacted. And I said, why, what happened to that much money? So he says, I have spent XYZ places. And he wants a 5 lakhs a month. It's not, so that lifestyle is that league. And now I'm finding that I may not be able to sustain. So most of the time, it's very important that when you have got a lump sum money, it can be business exit or a real estate sale, it can be your retirals, start putting into the right perspective of a goal, and then rest of it you should utilize and put it across. So this is the another things which I always tell across, the discipline was the key. Whenever you think about the long term or a short term, so this is what Kapil Dev has to say, the difference between, because both of them came on the similar time, they know each other, and Kamli was actually playing, he says, is a better than Sachin, but the difference between both of them was actually the discipline which took them where they are now. So this is my always best time quote. I love it. The successful investing takes time, discipline, and patience. This so true. We have to think what is discipline cannot be removed by any, you can say good luck, hard luck, whatever. But I always says that how matter your great talent and effort, something just takes time. Can't produce a baby in a 1 month by getting a 9 woman pregnant. So this is my all time. You start doing discipline. Discipline, my for me, it is very inbuilt. My dad was in army, so it came, I think so, with a way of living. But I can tell you the discipline is what makes you very, very happy. It can be a health-wise discipline, or it can be walking, or it can be investing. It can be anything what you feel. It's a social gathering itself. You make your own discipline routine and you do it, and you feel more high than anybody else, and that gives a result over the period. So this is the just talking about so many times. At least I am very clear. I don't take any customers who says I want a returns more than 14 to 15%, and they says I'm wanted in a short term. Yesterday, another customer called me from Dubai and he says I wanted to give XYZ amount, and for 1 year. I said please keep it in your NRE FDs. You don't have to come here and do it. And he's telling you are telling no to me, and I said no, I'm not saying no, but it is good for you because short term it's not going to make sense, and debt funds are the similar and you have FD tax free. So I am just trying to say, if you see the rolling returns, the bull and bear market time, you will just say it'll come between 12 to 14%. So expecting a return, somebody has told me very maybe around 1 2 years back, and he called me and he says, Rachna, I want your PMS. And I said okay. Then he says you will give me 30% return, and I said no, I don't think so. We'll give a 30% return. So he said, how much you will give? I said, you should expect around 14 to 15% and small and mid cap around 18%. So he says, no, your data says that. So I said, it says the past data I have been giving. It doesn't mean that future also I'll be giving 30%. So if it gives, it's good bonus to you, but you should not average. So I didn't know, of course, when calls comes to me, how I knew that what is the other side of the person. So he said, do you know whom you're speaking? I said, I don't know whom you're speaking. So he gave some XYZ person that I am this. Nobody has told me no to. So I said, even after knowing also, I will still say no to you, because people should have a very clear understanding expectations. If your expectations are not right, you will have your BP and anxiety high always, or you take a wrong decision when you are having a 30% 20% experience. So if you must have seen and heard last 1 year, all the scams happened because people gave them a carrot of saying that I will give you 20 to 30% returns. And for a change, actually most of our funds and others have given the 30% returns. So it is nothing wrong if fund manager itself will try, because their KRA itself is at how to outperform the benchmark, how to give the more returns to the customer. But when you chase the returns, actually you chase out your principal sometime. And that's another things you should start thinking about. Look long term, look very realistic, 14%, 15% returns. And I'm saying from my 30 years, I have never stopped SIP for last 30 years. I've never seen my SIPs, my team must be looking. I started looking my portfolio only 2 years back when the first goal came of my daughter going abroad for higher studies. So that was one of my financial goal, and I felt it, oh my God, I didn't know that it is my portfolio or not, because it was too huge. So most of the time, you have to continue doing your SIP in bear and bull time. Start looking your portfolio when you have goals coming across. And I'm assuming your portfolio manager or yourself is looking once in a year or twice in a year maximum. So you don't have to look every day. So it's another way I always say is, if you're keeping an FD or PF, are you going to PF office or an FD office that it is there or not there? Nobody goes. They assume it is there. So same thing, it should work here also. So power of compounding is the one thing which makes a difference as long as you are keeping. So that's another statistic says that only 5% of the people keeps more than the 10 years.
Chinese bamboo is the world's tallest grass, which goes up to as high as 80 to 90 feet in a little over 5 years. When you sow the seed and start watering and nurturing it daily, you don't see it growing for 5 years. It would be frustrating, isn't it? But wait, miracle happens after 5 years. It grows from 0 to 80 feet in less than 90 days. Similarly, growing wealth through SIP also requires a lot of patience. Had you started an SIP of rupees 10,000 in September 2010 in large cap fund, the value of your total investment of 3.6 lakh rupees would have been 3.57 lakh rupees after 3 years. Had you stopped an SIP, this temporary loss would have been permanent loss. But had you continued an SIP at the end of the 4th year, your value of total investment of 4.8 lakh rupees would have been 6.95 lakh rupees. And if your SIP still continues till March 2019, the value of total investment of rupees 10.3 lakhs would have been 17.38 lakh rupees. Remember, correction is temporary, growth is permanent. So continue your SIP for long term to create wealth.
Mutual funding.
So this is the another topic which I wanted to explain why people normally says they should avoid. So when I do a lot more induction programs or even of course I go to the colleges for the session. So I always says that try to save early. And most of the time whenever I get a prospect of people, they always says me, Rachna, why you didn't meet me early? I have lost so many years. Because most of the time I have noticed people start saving or maybe from our customer side, I can say people normally comes by 30 or 35 when they got married or a kid. Then they started seriously thinking of the goals. It can be kids education, retirement, house or something. And then they will say, oh, I wanted to retire by 2055. So if you think somebody has started investing only by 35, where they have a full family commitment of EMI, a house, kids' educations, vacations. And then by 55 to average 85 is the B2 longevity. So 35 years, you wanted to get back the money back. So you're not even saving that much in 20 years and you wanted a 30 years to get back. So if you must have started early, how it will be easy for this. And that's I can always is the God grace. Anil, of course, is in and out of this. So when we started from the first, my parents and we started saving from the day one. So it may be around 22 or 23 years onwards. So that gave him a chance to retire by the age of 30 and start his own company. So because he made that much of corpus that whatever required for the home, it was there. So most of the time, try to start early. I always said it is okay to start with a 1,000 or 2,000. You don't have to have a tons of money or something like that. That people always says, Mama, madam, I don't have a money. I said, we have a money, but we don't have the consistency of saying, okay, one weekend I will not go, or one take home or dinner lunch I will not get from outside. That's the only difference. So one not going is not changing your lifestyle, but that 1,000 rupees can give you a good discipline, and that discipline will make it a 10,000 to 1 lakh. You will not even realize. Whenever you are saving your money, at least we says minimum 20 to 25% of take home, you should invest first, not save, invest. And then you should spend. So why we say always in percentage? Because your money is going to grow. Your as you grow, your maybe 1 lakh will become salary of 2 lakhs or 10 lakhs or whatever. So what happened when this percentage wise, your that amount also increases. Power of compounding is always the eighth wonder of the world. Nobody can think about it, how it has been growing. And this is the real story itself of one of our customer, very good friend. Most of the time, people used to gain so much of money because they used to take an IPO and keep it. So after the death, when he dematerialized, it was such a value itself. So most of the time, I tell why people are not able to become a Rakesh Jhunjhunwala or Warren Buffett or anybody who are the one of the punters in the things. Everybody was new, but who is a person who is having the funds or maybe Titan or any other stocks for 30 years? Nobody keeps for 30 years. And that's the reason they are where they are. And we don't want it to, after 5-7 years, even if it's 15-30% has grown, okay, I will sell Rachna and do what. So I always try to say, it's okay to sell or not to sell, that's your own call. But what you will do with that money, that you should be aware of and where you're going to utilize for. So this is the another concept of things which always says that if you notice it, if he started from 14 to 25 years, the all his compounding has come so much. If he has just made 10 years delay, just 10 years delay, the difference is how much it is, not 90 billion versus a 11.7 million. That is the difference. You can see the compounding can make it in your portfolio. So this is the most of the time power of compounding. Indirectly, you can think of it is long-term investing. You can say it's a discipline. You can give anything, but make sure that you continue. The market is fall or market is up. That is going to give you the best return. So this is the one of our customers I have taken, I think so, year back plus. If you see the compounding returns, the gap itself is trying to show the how the power of compounding, it has been growing as the time has increased. That customer is 2004, and the compounding has started coming, you can say it's around 2014 onwards, and this is the 2012 value, and this is the difference is coming on the live example. So I'll just skip this for the a matter of time, so I'll just take the more questions. That's another question is how to manage risk and returns. Try to diversify. So that's sorry. So it is another one. A person has told me, Rachna, she's a doctor and all. She called me and she says, Rachna, I wanted you to help me in investment. I said, yeah, why not? So she said, I don't wanted to take risk and all the stuff. I have got grace more money than what I required. So why don't you give it to me with the low risk? Give at least 12 to 14% returns. And I was that particular time, I always tell Anil, actually people knows me because I laugh more or talk more. So I don't know, I should laugh or cry kind of it, because somebody is, I always feel, is it people are so gullible or non-knowledgeable, because that person is a surgeon, knows in and out. So must be knowing something. So maybe our thought is wrong and assumption is wrong. Somebody is telling me, I don't want a risk, but I want 12 to 14% returns. Because that itself, and that's one of the reason I do these webinars. I know how much I can try to do or speak with the people. We should know what is the expectation on the risk. I always try to explain the easiest way for a people risk is if you are going in a FD or PF insurance, where somebody is giving you in advance that this is the return you will get. It means that it is a low risk, not no. It is not NO, it's a LOW. It's a low risk, because even in FDs, if the bank get NPA non-performing asset, even it's a 5 lakhs or 50 lakhs or 50 crores, you will get only 5 lakhs back. So there is a risk. It may be a 0.0001% risk, but there is a risk. So most of the time, we should know when there is a low risk, people will give you around 6 to 7% returns. But when there is a, as I showed you, equity means stocks. So stocks is how the companies are doing good and accordingly you get it. So that is, of course, have the highs and lows depending on. So normally I say there is a cycle of high low is around 8 years. That's what we people say. Giving an example, like Harshad Mehta scam was 92. Then 2000 was a dot-com burst. Then 2008 was Lehman Brothers. Then 2019 was a COVID onwards. So normally you will see that most of the time there are different names, but the life cycle is around 18, 9 years old. So if I take an average of that, you will get 12 to 14%. So high risk is considered as 12 to 14% returns. And if it is a low risk, it's 6. Moderate is a weighted average of 4. If I want a 50-50%, so means 50% of 6 is 3 and 50% of 12 is 6. So I'll get 9 to 10%. That should be your risk and return expectations. If that expectations are not matching, you may get, may not get, depending on, or you may lose capital or not. Please try to understand you are taking a risk. It is always good to understand, like if one customer told me, Rachna, this AIF he's sending and this is guaranteed at 12%. Whenever somebody say me this, no, I always says, okay, very nice. I will also invest. Why don't you give it to me, the data? I will take care of it. And when you start reading the data, And then I told him that he is taking the highest risk, he's hedging the funds. And they said, no, they didn't tell me. So I said, it's like I'm not telling the truth, I'm not telling the light, I'm just telling fact what I wanted you to listen. So sometimes that is the another things you should try to understand. I'm not saying that everybody is right or everybody is wrong. God, it has given us such a wonderful thing of full internet business itself, that we can try to understand the risk. Is it I have an appetite or not? So try to understand what risk you are taking. And it is okay to have a risk, because with the risk you may have a good returns also. And risk over the period it reduces. Like if I have a fund which I'm keeping for 7 8 years, I may reduce the risk by over the period. Maybe SIP, STP, averaging, all those things is being taken, because market will take care of those part of it. Last but not the least, which is the herd mentality. This is the most common thing which I get it from most of prospect customers, family, friend, everybody. That they will say everybody is thinking alike, then nobody is thinking. So that is another thing which I wanted to play, and then I'll take the question answers.
Familiar with the phrase called herd mentality? We all are victims of it. In 1950s, psychologist Mr. Ash performed the experiment to test the effect of herd mentality on your decision. He called the group of participants and he drew 3 lines and asked them to identify whether an A, B or C is closest in length to line X. Out of all participants, some were actors and told in advance to give the wrong answer purposefully. First, second and third actor gave C as an answer. The actual participants got confused and gave wrong answer just like others, though he knew the right answer. Ash did these experiments with many such groups and found that 75% of the participants gave wrong answer to go along with the group. This is called herd mentality. While investing also, most people get caught into herd mentality and want to invest into hot stock or sector where everyone else is investing. It's human nature to follow others, but when it comes to investing something which is right for everyone else, may not be right for you. On other version of the earlier experiments, when all participants were given a partner, only 5% of them gave the wrong answer. Having someone to advise you decreases the chance of getting caught in herd mentality. To ensure that you don't become the victim of herd mentality and stay on disciplined approach towards investing, call us.
So most of the time, as I said, if your family, friend, yourself is going to invest, so please don't make sure that because they are investing, I should also invest. It's maybe a good fund, understand, and then take the aware decision, because their goals, their investment pattern, their income patterns are very different than yours. So that's another things people says, okay, for me, why I have to take risk, I will do the best part is only through the fixed returns. It's okay if you are able to achieve all your things, taking care by the fixed return, it's the best to do, and privilege lots. But very, very few we have seen that people are not able to do because it's not creating wealth or the compounding returns. So if you have to think about this, is always think that any of my returns post tax, post inflation should be greater than 0 for the longest term. If it is doing that and making sure that it's achieving your goals, it's good to go. So I'm just summarizing that how not to have avoid these things with the mutual fund. One is make sure that don't expect too much of, I can say, returns or performance which is not a realistic kind of it. Don't go with the herd mentality. Don't go with the ranking. Don't go most of the time. They don't do diversification or asset allocations, and link all the whatever you're doing to your goals. So this is, I'm just giving that how if somebody has started early, must have got so much of money versus the same money. It started little 10 years late. There's a difference of 1 crore plus. Have the investment very clearly how you wanted to do when you are in 20s and 30s and 40s and 50s. You should know where exactly you can do when you are young. You can do 100 minus your age into equity. It is you are having a good life cover to take a power of compounding. Make sure you have the whatever investment, at least 25% of your take home. Make sure you have an investment for the emergency or contingency funds. Try to take care of your term and health cover before you start doing anything. Every season is not an harvest season. There is a season for watering, planting, pulling the weeds, and fertilizer. Think about that. And all this, whatever I'm saying, investment is a, like I can say, verticals or the horizontal. These are the products. But what is our main goal is to make sure that all of us achieve the financial planning and financial freedom, which is take care of risk, contingency, and all our personal goals. With this, I just stop the presentation and happy to take any of the things. This is the last slide where I have normally says a fixed returns I have already explained, which is a low risk returns. And non-fixed means I have put it means the you get a returns only when you sell. It can be equity or a gold or a real estate or a ULIP. So these are non-fixed where you have the, I can say, a little bit of risk, and risk normally can be reduced over the period when you stay long. Always try to do identify your goal, which is long, short, and mid. Long is above 8 years, short is below 3 years, 3 to 7 or 8 years is midterm. Financial goals and quantify that I wanted to have a house after 5 years, which is 1 crore, or I wanted a retirement after 15 years and I should get a, I can say 1 lakh a month. What is my risk level? Take a risk levels higher till you are working, then you can reduce it. Invest and map everything with the goals without fail. Otherwise, you will stop it or redeem it. Make sure that you invest whatever home in hand salary comes or in hand money comes as a business. If you are in 20% goes there. Try to have post tax, post inflation returns. Balance risk and returns reduced by SIP and STP. On an average, you should track twice in a year.